You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? Mike from the Moose on the Loose. Happy Thursday. This week, I am talking a lot about the difference between low yield and high yield and how they fit in your portfolio. And this is what we're going to talk about today. Can you have a stock like Enbridge and a stock like Dollarama in your portfolio and still make sense? And the answer, short answer is yes. So there you go. You don't have to listen to the full 10 minutes and then you can go on with your day. I'm just joking. But yes, you do have this option of investing in high yield and also low yield, high growth stocks and still be coherent in your investment strategy. And that is based on the fact that I see portfolio building like I would build a championship winning team. So if you're looking at a hockey team, for example, well, yes, you need a lot of offense, but you also need to have some pretty good defensemen and stay at home players that will actually be able to counter the other team. So it's a team effort. You need different types of players in your portfolio. I don't believe you could win with 12 Connor McDavid in your team. That would be amazing, but if you have Connor McDavid as a defenseman and as a goalie, I'm not too sure they will be great, right? So it's just a matter of like having different type of players playing different roles. So when I look at my portfolio, it's pretty much the same thing. It's even more important if you invest 100% of your money into the stock market. So when I look at my portfolio, I'm always 100% invested, but that means that I do not have any fixed income. I do not have any cash. So my portfolio is wide open and exposed to major market fluctuation. Do I mind? Not really, because this is my style of investing and I have a very high volatility tolerance. I know it's not the case for everybody, so I'm not telling you that it's the only way that you can achieve your goal with your portfolio. It's one way, but there are like a zillion strategies that will work. The key here is to find one that you believe in, that you're comfortable with, and that you can stick to it for several decades, because that's the key. Sometimes I get challenged about, but I don't think you're going to do that if you retire, or I don't think you're going to do that if the market goes down, or I don't think you're going to do that because if interest rate goes up or goes down. And my answer would be, yes, I will keep the same strategy, because if you keep going from one strategy to another, like every 3-4 years, regardless, like depending on what's happening on the economic environment or who's running the country or whatever reason, well, you do not have a strategy. You're just like shifting from one place to another, trying to hope to get a good ride along the way. But that's not really a strategy. So instead, I rather to be coherent and focus in something that I understand that it is simple, that I have like stable rules. So going to my portfolio now, my yield is about 2%. My dividend growth rate over the past 5 years is about 9%. So definitely going for that low yield, high growth, high dividend growth profile. However, I do have some high yielding stocks in my portfolio. So over 5%, I only have one. And when I bought it, it was not the case. Of course, I'm not super pleased with the latest performance of TELUS, but I'm not worried at this point. I've done a lot of review. I've done a lot of digging into their financials. And at this point, I'm okay to have it in my portfolio, even though it pays a yield that is close to 7%, which is a bit crazy. But I'm willing to hold on to this one for a little bit longer because cash flow metrics are improving this year. And if it keeps on improving next year, well, I am confident that the stock will get some love and therefore their yield will go back in line. In the 4% category plus, I do have some other companies, and all of those companies, they have like a full position. So when I say a full position is a stock that has like at least 2.5 to 3% weight in my portfolio, and not just one portfolio, but really across all my assets. So not necessarily just my pension plan, but really all of those. So Canadian Natural Resources at 4.84. So that's pretty like of the yield. So this one is a very stable business. I'm not a big energy fan, but this one is an exception because it has proven me its business model can go through all kind of storms and still the business will be able to increase their dividend. I do have two Brookfields, so Brookfield Renewable and Brookfield Infrastructure. Both of them pays a yield above 4%. Well diversified utility businesses. I like how the business are managed. I like the diversification. And even though the performance is quite hectic on the stock market, when I look at their funds from operation per share, it's usually going up. The dividend is going up, and it is managed by the Brookfield parent company, which I've been doing great over the years, so definitely happy to have them in my portfolio. And the last one is Granite, GRT, though. So this one is paying a 4.4% yield as well, paying monthly. So definitely doesn't make much sense, right? Because if I look at the rest of my portfolio, we're talking about a REIT, we're talking about like monthly distribution. It's not what I'm looking for right now. So does it make sense to have those relatively high yielding stocks for a portfolio focused on low yield, high growth companies? Well, here's the thing. My strategy is all about dividend growers. And the company that I just mentioned, TELUS, CNQ, BEP, BIP, GRT, they all show dividend growth. So that's the whole point here is they are coherent with the rest of my strategy first. And then the second thing is it's important to identify the role of each stock in your portfolio. So for example, I do have also companies offering a 3 to 4% yield. Those are kind of like the perfect match where you have a balance between income and great metrics. So in that small list, I have like Fortis, National Bank, and Royal Bank. So those are also really great companies. But I'm not expecting Fortis, National Bank, and Royal Bank, or even CNQ and the Brookfield or Granite and even TELUS to drive my portfolio returns like crazy. I mean, National Bank is kind of an exception right now. It's doing both. So offering a decent yield and on top of that, driving with strong performance. But in the end, those companies are there for their stability. I mean, we need power, we need energy, we need telcos, we need banks. Those are the reason why I have them in my portfolio. They still show strong fundamentals. That's number one key for me. But their role is definitely not to bring that portfolio like a return of like high single digit to double digit return every single year. The role of those of those holdings is a little bit to replace the portion of fixed income I could have in my portfolio. So I'm not a big fan of fixed income, mostly because I just want to grow my portfolio as fast as possible. But at the same time, I kind of like to have those stay-at-home defense men that are able to go through all kind of like crazy market and still perform. So that brings a good balance between the yield they pay, the stock price that they move a little bit less versus all those like low yield, high growth stocks. Ironically, when I talk about stability, I always have other type of companies in mind. Companies like Microsoft, Costco, Visa, automatic data processing. Of course, Fortis, CNQ, National Bank are there, but they are providing a lot of growth in my portfolio on top of a lot of stability. So as you can see, there are a lot of names there that have low yield and still are very stable businesses. They provide constant growth quarter after quarter, year after year. So there's no correlation. I've seen that a lot from investors. They make a correlation that if you pay a low yield, that means that your stock price is highly volatile and it's going to go all over the place. Not really the case. There are like some companies that are highly volatile and they have a high yield and vice versa. So you do not have, you shouldn't like have this bias in mind, because each company is different. So it does make sense to have a company like Enbridge and Dollarama in your portfolio, depending on the type of roles and the balance you have in your across your sector and stock allocation. So on the opposite side, I would also say that it makes sense if you have a wide number of companies paying a 4, 5, 6% yield, and you still have like a few Dollaramas in your portfolio at the same time. It's just that your focus is geared more towards income and less towards total return, which is again totally fine. I mean, if it makes you happy and if it helps you to sleep well at night, that's great that you have that build that portfolio, but it doesn't mean that you cannot add a few spices to bring a little bit more growth to your investments. And here's the key. As long as you have a clear strategy and you know that 80% of your portfolio will be focused towards this type of stock and then the other 20% towards something else. So in my case, it's pretty much 80% are about strong dividend growers with low yield, high growth stocks. And the rest of it is like relatively mid yield, I would say, with still a generous dividend growth policy. That's the key here. So find your perfect balance and then stick to it, and you're just going to be a better investor at this point. So, all right, guys, that's enough for today. I'm already at 11 minutes. So I hope that you have enjoyed this podcast. We're going to talk again tomorrow. And until then, don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy this show and do your due diligence after it.